so much for joining me on the Show Me the Money episode. Before we get started with the Show Me the Money part, though, the trigger of the week. Little mic brushings. Relax. 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 Welcome back. So, as I've been saying over the past couple of episodes, 2018 was the first year that the stock market lost money. We logged a negative number since the Great Recession of 2008. So that's like 10 years later. So that was an amazing bull run of the market continuing to go up. And so I remember in 2018, of course I was still working, right? Remember I talked about last time the sequence of return risk. If you're still working, who cares what the market's doing? I mean, really, as long as you have a job, you have income coming in, and you're investing, don't worry about it. Control the things you can control. So in today's episode, I want to share with you what the market did, what my balance was, what my portfolio returned, and then I'm going to wrap up and kind of anchor back to some episodes a little while ago where I talked about, what if this was a down market and I was retired? I'm sorry, it was a down market, but if I was retired, what would have been my thought process for a 2018 type of a year? So the first thing I wanted to share with you, my salary, my gross salary and my bonus equaled $92,629. So I remember thinking I had not yet in my career ever gone over $100,000. I mean, so think about that for just a minute. My salary over the course of multiple years, started at $40,000. I think I was making about $40,000 So let's add 54,000. $639,000 is what I would have had at the end of 2018 if there was a 0% return. Does that make sense? Yeah. 585 plus 54 is 639. There was no growth, there was no loss, 0%. But really, I ended the year with 606,000. Now that minus the beginning balance, I still ended up by $21,000. So I didn't get 639,000. I got a lot less, but it was still 21,000 above what it would have been, if that makes sense, because I'm putting in $54,000 of my money. And here's why. My portfolio, I logged a loss of 3.5%. So it almost went down 4%. The balance still was higher, again, because of the amount of money I was putting in. But it would have been a lot more, as I just shared with you, had the market been 0, or if it was a positive number. So the S&P 500, by the way, for 2018, if you Google it, you'll see that it lost 6.24%. So my portfolio lost 3.5%, S&P 500, 6 and almost a quarter. The reason why my portfolio didn't lose 6% is because I had a blended portfolio. Does that make sense? I didn't have all of my money in stocks. I had some in stocks, some in bonds. It may have been a 60-40 split or a 50-50, almost a 50-50, because 6.2 divided by 2 is 3, right? Does that make sense? So if you think about it, then as you get closer to retirement, you want to have a blended portfolio because, see, the loss was less than it would have been than if I had all of my money in stocks. So, in considering wrapping up this episode, the key takeaways really are that, again, because I was still working, I really didn't care that the market went down. I was perfectly fine. In fact, I was putting the money, that $54,000, and buying shares when they went down, like I talked about on the last episode. So that is a major plus in and of itself. And the last thing I'd like to share with you in today's episode is, like I mentioned last time, if I have a 2018 in the future after I stop working, that's when I'm going to pull from my cash reserves and not sell any of the shares whatsoever. I want those shares to sit there. It went down a little bit, but it's going to come back up. And that's when you, of course, use your cash reserves on the side in times when the market is down, when you're in retirement. And the good news is, as you may know, bear markets are few and far between, or bear or down years, I should say, are few and far between from the good and the up years. I just kind of proved that because from 2009, 10, 11, 12, 13, 14, 15, 16, and 17 were all up years in the market.